The dividend is split. I want to get a sense of how tough a negotiation this was with the regulator, or was it quite a bit of pressure to get there?
No, I think that's, first of all, I can tell you that we reiterated clearly that the strong capital funding position and the business mix we have would have allowed us to confirm our dividends. We got a request from FINMA to consider the situation, reconsider the situation, and I think that we took the decision that in order to balance the interest of all stakeholders, including our shareholders, we took this decision to split our already announced dividend in two tranches.
Is the 2020 dividend and buyback program at risk as a result of this move?
I think that it's premise. I mean, first of all, we already announced that we would suspend any share buyback following the second half of the year, and the coronavirus situation has only confirmed that it would not be prudent to continue with share buyback. So the share buyback team has already been postponed to the very late part of 2020 or for the future, and so there is no topic, no discussion on that point. Also, for the 2020 dividend, it's too early to make a forecast. We're gonna think prudently about balancing our desires to keep a very strong capital position and also serve our clients, lend where appropriate and necessary, but also we will take in consideration the needs of our shareholders in terms of capital returns. So this is going to be a balanced act that we can only consider at the end of the year.
You gave some guidance in terms of the first quarter earnings, $1.5 billion. The market had penciled in a lower number for you there. Give me a sense of what kind of lending to the wealth management side of the business. Has that been part of the driver of this beat, or where has the alpha come from?
No, I think that, in terms of, I'm glad to see that all our businesses had a very strong operating performance, and our lending activities have been there in across all businesses in our personal banking and corporate banking in Switzerland, where we have been helping to speed up the process of releasing liquidity to SMEs, but also to larger corporates. I think that we have had and we are working also with in the U.S. With an allocation of $2 billion for loans through the Paycheck Protection Program, and so we saw demand for loans and credit in the investment bank, and also in the wealth management space. We saw some deleveraging coming through, but also some new demand for credit, and which has contributed for sure to an increase of our lending balances.
Can I ask you, Sergio, in terms of the markets, we're back in bull territory on the DAX and the S&P 500. Do you think that this turnaround is rational? Does it make sense to you, such a virulent return to bull markets in the equity side, first of all?
Well, I think that if you try to rationalize too much things that happened in the last few years, you would be at a struggle. So I think that, in my point of view, is clear that it's good to see markets rebounding, but on the other hand, I do think that the market is a little bit is expecting embedding a recovery in the late part of this quarter, or a normalization, I would say, and then a recovery in the second part of the year. I would say that there is, in my point of view, a downside risk to that scenario, and in that sense, I would be careful about getting too much exposure in equities at this stage.
Jamie Dimon warned of a bad recession, echoes of 2008. Do you see any echoes of 2008, Sergio? We talked about counterparty risk in 2008. Where is the systemic risk in the world today?
Well, first of all, I think it's very, of course, you have risks both sides. I think, as I just mentioned, there are maybe the risk is that, in a sense, it could well be that we would see a very welcome V-shaped recovery. I don't think it's the case. On the other end, you could see a severe downturn of the economy. I don't think anybody's in a position right now to call exactly what happened. Uncertainty is still the main driver will be the main driver for the future, for the near future, for the markets, and also together with fear. And in that sense, I think that it's very difficult to make a forecast about how the situation will develop.
Okay. When we last spoke just a couple of weeks ago, we spoke about credit, and you say actually managed the dislocation in the credit spreads as something that didn't add up for you and provided an opportunity. Howard Marks say that investors need to be more offensive. Credit is still an opportunity. Do you see that still as the case, Sergio? And where in credit would you be suggesting the opportunities lie?
Well, look, first of all, I think that there is still some value to be picked up in equities in selective situations. But if you look at still today, there is a better risk-reward in credit because I think probably credit markets are more critical or more realistic about how quickly the recovery can materialize, and in that sense, we continue to see more opportunities in particularly in the U.S. high yield and investment grades, and to some extent also in emerging markets sovereign debt.
When you look at the Fed's policy response, Sergio, do you interpret that as moving towards yield curve control? Are we there yet with the Fed?
Well, right now, I think that's, as I mentioned last time, I think the Fed and in general, policymaker and central banks have done a great job in stepping in, not only stabilizing but also stimulating to the extent they can at this stage the economy and also stabilizing liquidity tensions in financial markets. I think that's I can't see much more they can do at this stage because there is nothing you can do against fear. And it's nothing you can do against uncertainty at this stage, and it's only when things normalize that we're going to see if and what is still necessary to be done. But a lot of ammunition has been spent, and hopefully we're going to see the results in the next couple of quarters.
Sergio, you're bringing some of your own personal ammunition to bear. You've contributed a million Swiss francs to your local area there, Ticino. Are you setting an example for the rest of the board? Will the rest of the board follow you in terms of giving contribution to coronavirus?
Yeah, I think that my intention was not to try to set examples to anybody or internally or externally, but try to do what I thought that is the only thing I can do is to give money because, of course, there are experts out there that know how to fix certain of these issues. So, in that sense, of course, my colleagues in the management board have already committed to donate 50% of their next 6 months fixed salaries for causes that are related to COVID, and in that sense, I don't think that they necessarily need any example, and we are all well united, and everybody tries to do what is possible to be done in this very difficult environment.
It is a hugely difficult environment. There's one final one, Sergio. I just wanted to see if we can get some idea. You talk about credit losses and credit valuations. Have you any any estimate for me in terms of the numbers that are involved in credit losses in this quarter? How bad could it be?
Well, look, at this stage, we are not really disclosing the details of the quarter. I think that if you look at the net profit numbers that we highlighted as a guidance for the quarter, and it highlights that while you may have had some of these elements offsetting the strong performance of the businesses, they can be very relevant, but we will give more details in a few weeks when we report our Q1 results.